Hello, everyone. Welcome to the next edition of the PwC Tax Bite podcast. Today, we will talk about COVID and transfer pricing, two topics linked to each other, but not easy, I think. And that's why I have invited Jonas, Alexis, and Stefan, all part of our global tax and transfer pricing team in Belgium here, to have a discussion today on the latest developments there. And there are some interesting documents, I understand, that have been released in December. So that will be the starting point for our discussion today. And perhaps to kick off, Alexis, may I ask you to just introduce and give the latest status here on the COVID and transfer pricing?
Thank you, Peter. Indeed, maybe briefly, I'll set the scene. So the OECD released in December a guidance document on the transfer pricing implications of the COVID-19 pandemic. And the first thing I'm hearing now from our clients is why so late? It is true that now managers are very busy and focusing on their closing of the financial year or half year. And addressing this guidance now is clearly a challenge. But apart from that, I also want to point out several merits in this document. One, it's a consensus document. So we should not forget, like that long time ago, and I mean before the BEPS era, the OECD guidelines were also a consensus document, and the last version is not representing anymore a consensus. So I think it's positive to see the OECD bringing back an unified perspective. Two, the document has been published in the context of the COVID pandemic, but the guidance is actually useful for many different types of disruptions in supply chain. So it's good to have this guidance for the future. Third, the guidance recognizes the difference the pandemic has among multinationals. And when you see that the luxury goods industry, for instance, grew by 50% in China in 2020, we can't apply the same principles to an airline company in Europe, for example. So this is also good to see that the OECD recognized that different industries have different impacts. And the fourth merit I see is that over the last years, we saw many tax policy initiatives directed to taxpayers mainly. And while here, this guidance is much more balanced, in my view, between the governments and taxpayers. So that's also a positive element. But I think looking at this paper and this guidance, I think it's worthwhile if we can summarize the content by sharing some practical experience. And maybe Stefan, I'll ask you the $1 million question. What can we do in terms of comparability analysis and benchmarking studies? What do you think there? What can we take out of this?
Yeah, thanks. Thanks, Alexis. That indeed is $1 million question. I mean, transfer pricing is pretty much based upon comparability analysis, benchmarking studies, and also then related to that is, of course, the period under which these data becomes available or is available. And usually what we see here is that we rely on historical data when we do a benchmarking analysis. But the problem is there that relying on this historical data because of the COVID pandemic might become burdensome because the benchmarking studies or the data used for the benchmarking studies have not been influenced by the COVID pandemic, but that is precisely what we need to address, how to deal with the period during the COVID. So there is an issue there that there's an element of timing, a timing issue between the data that is available and the data that is not available. Also, the point is when we go, and hopefully we come out of the COVID pandemic pretty soon, is after the period when you go, I mean, when you do your benchmarking analysis, the data you have may be influenced by the COVID pandemic. So again, there may need to be room for comparability adjustment. So the point is to make use of contemporaneous information such as changes in sales volume, but because of the COVID pandemic, not because of other economic reasons, capacity utilization or underutilization because of the COVID pandemic. What are the costs, incremental costs, exceptional costs that have been incurred? And these kind of elements are important. One guidance that the paper also does is perhaps that we can aggregate the exceptional years, for example, under the COVID pandemic, with normal years. So as a kind of flatten out, as a kind of, I would say, average out the figures coming out of the benchmarking study. So that's one way of treating, at least according to the document. The second element I would like to raise with you, and that is also raised in the document, is the allocation of losses and of extraordinary expenses. Because for example, can a limited risk entity incur losses? And yes, it can be under specific circumstances, but for a short run, for a short time, and that is also what is in the transfer pricing guidelines as such. Extraordinary expenses need to be related to the COVID-19 pandemic, so not all extraordinary expenses can just be allocated to anywhere. But I think we might have an example there.
Yeah, yes, Stefan, because actually to make it even more tangible for our listeners, I think many multinationals have limited risk distributors in their value chain. So the OECD is using this example. So if you have this type of distributing company, taking, for instance, the flash title of the goods, well, it is clear that an exceptional inventory write-off shouldn't be allocated to that distributor. But the positive side is that the OECD recognized that it's not because you are a limited risk distributing company that automatically you cannot have an exceptional cost, and that a limited risk distributors assumes some marketplace risk, and consequently it may at arm's length to earn a loss associated with the playing out of this risk. So this is also important to recognize, and it's welcome that the OECD put that example.
Thanks, Alexei. This is very useful. Very useful example. Thanks. The third point that is addressed in the OECD paper is actually the impact of government assistance programs. And as we all know, governments have gone quite a long way in reaching out to enterprises through these assistance programs. But these programs can also have potential transfer pricing implications, because either they are, of course, these programs are addressed to the enterprises themselves, or as a secondary effect, these advantages can be passed on to independent parties in the market. So this element is not for all subsidies or not for all government grants that the guidance is there, because they again make a distinction between pandemic-related government assistance and other programs that governments may, for example, like subsidies that governments may put on the table. So there can be a direct or indirect economic benefit to the taxpayers, and there's a multitude of programs, for example, wage subsidies, debt guarantees, loan guarantees, and all these elements may, of course, have a transfer pricing impact. Also, what the paper flags is there are differences between countries. So because of those differences, again, let me link it back to the first element discussed, the comparability analysis. There can be possible differences in comparables, making this, again, a more complex exercise. But I wonder, are there any second thoughts about this, perhaps, Jonas?
Yeah, thank you, Stefan. I think that the guidance is not that straightforward to immediately apply for groups. And as you know, Stefan, the topic is also not that new. You make reference to other type of subsidies. And we also know that there have been discussions, for instance, with the Belgian tax authorities around this subject, how you actually deal with that one in a related party context, and who should keep the benefit of receiving a certain subsidy. And it's actually, I think, even now included in our own practice note in Belgium, these type of examples. So if you read the text, you could say, well, there are circumstances in which you might potentially want to share it with a foreign related party. There are circumstances in which you would not do that. And so what I find interesting as a framework to analyze these type of examples is actually the reference that the OECD seems to make to the location advantages, where you actually say, well, is there actually a benefit present from receiving this type of government subsidy? Would I actually, under third-party circumstances, give this away, for instance, to a supplier or to a customer? And if I wouldn't give it away to a supplier or a customer, so a third party, how would I actually allocate that with a related party? And I think that analysis will be very crucial. And I think that will also depend on the history and the legacy of the relationship between parties. It could have well been that an entrepreneur has been responsible for supporting a local manufacturing operation for years and years, and that all of a sudden now it gets access to government support. And then you might say, well, I will do something in return and take some of the heavy lifting. It might also be that that is not the case, and that all of a sudden volumes have drastically decreased, and that the manufacturing company might simply have to hold on fully to the government support, for instance, to make sure that they can still be operational once COVID effects are actually reduced. So I think it will be very fact driven, very individually company driven, even very country driven. So groups should very carefully analyze what to do with it at this point in time, rather than having to look back in a couple of years from now, I would say, Stefan.
Yeah, thanks, Jonas. Also, that's very insightful. The fourth element that is discussed in the paper are advanced pricing arrangements, or APAs. And one critical question, of course, that automatically pops up because we are in different environment. The COVID pandemic may have influences on the profit level. Will there be a breach of critical assumption? And if there is a breach of critical assumption, will this lead to a revision, a cancellation, or a revocation of the advanced pricing arrangement? Well, there the guidance actually says, well, because we are now under this COVID pandemic and because there are economic influences, there should not be, I would say, an automatic cancellation, revocation, or revision of the APA. This all may depend, of course, but what the paper invites is to take a collaborative and transparent approach. In particular, for the existing APAs, you need to see what are the economic conditions and whether they are related to the COVID pandemic. If there is, of course, a breach of the critical assumption unrelated to the COVID pandemic, then of course it may become a different situation. But the collaborative and transparent approach demanded here in the paper is indeed because of the COVID pandemic. Also, what they request is an early notification of taxpayers. If you see that things might be a bit out of the order in the APA, is to already to contact the tax authority or authorities to see how things can be remedied. There's also the element of APAs under negotiation, where also a flexible and collaborative approach has been asked to both taxpayers and tax authorities. So these are actually the 4 points that are discussed in the paper: the comparability analysis, how to allocate losses, how to deal with exceptional costs, the government programs, and how to deal with existing or new APAs, Peter.
Yeah, thanks, Stefan. And this was a very interesting, I think, interaction on the paper that was published. So I understand it. I understand that the paper indeed addresses a number of these important questions that many businesses will be confronted with. What do we do with the losses, the validity of our APAs, comparability issues, and so on? And the paper, it's good that it's there and consensus based. What I have a bit as question now, and I think and many of our listeners will have the same question, is, well, what do we do with this? The paper addresses a lot of topics. It's not always, I think, that explicit or that clear what to do. So Jonas, may I ask you, from your experience in the transfer pricing trenches and your discussions and interactions with business, what can business do with all of this?
Yeah, quite an interesting question, Peter, and in essence, not a very straightforward one to answer. But maybe if I can pick on 3 elements. One is quantify. The second one is sustainability and consistency, and the last one is timing. So maybe as regards the quantification, I think it's important for groups to first measure the exact impact that COVID had on their results, and maybe not just on a consolidated basis, but also on a country by country basis. And so we've seen lots of groups that saw a decline in their results in the first months of the initial lockdown, so March up to the end of June, that they were reaching out to us saying, well, should we adjust our transfer pricing policies? Should we do mid-year corrections? But that came back a couple of months later saying, yeah, we didn't quite do that because we saw actually a pickup in results in a number of countries in the period after July. And so I think it's important first to measure and to really be in control and to really understand what are you actually what are we actually talking about here in terms of ultimate impact. And the second one is sustainability and consistency, meaning that, of course, groups look at transfer pricing policies with the aim of making them sustainable over time. And often groups have been producing master files, they have been producing local files, they would have had contracts in place for a number of years. And so it's very important before they take a decision as to how to deal with a certain impact, that they analyze what is actually the material and the positions that I've been sharing with tax authorities around the globe. And is the adjustment that I'm going to make actually part of a sustainable tax policy? Is it part of a consistent storyline that I've been telling to tax authorities all over the world? And the last one is timing, and I think that is a fundamental one. Groups are required to take a decision today as to how they're going to deal with the results of COVID in local jurisdictions. But they, of course, have to acknowledge that the interactions and the discussions with tax authorities on those positions might only be conducted in 2 to 3 years from now. And at that point in time, Peter, the economic circumstances might have totally changed, and we might no longer be talking about COVID or the impacts of COVID. And a tax authority might also look at the implications in a very different way. And for instance, if you have adjusted returns to the lower end, a tax authority might also ask in a couple of years from now, am I also benefiting from the upside now that you also made me suffer for the downside? So I think you have to very carefully consider, and I think the quantification, sustainability, and the timing aspects, I would recommend all groups to reflect carefully about those before taking a final position.
Well, thank you, Jonas, for making that even more specific now in what companies can do. Okay, so it's taking an informed decision, reflect before you act, and document that. So yeah, thanks for that. It's very, very concrete guidance, I would say. That brings us to the end of the podcast. So of course, I imagine if some listeners still have questions, I'm sure you will find your way to Jonas, Alexis, or Stefan if need be, because it was a quite interesting but complex topic to deal with in a short podcast like this. But I thank you all for joining and tuning in, and of course I thank Alexis, Stefan, and Jonas for the interesting interaction and discussion. I hope you will follow us on for the next podcasts. Some of the topics we will deal with are Brexit and some interesting case law that is developing. So I would say stay tuned and also share your feedback. Do you like the podcast? Are there topics you want to discuss with us? So let us know, and we can take that into account. And for now, I thank you for joining us.